me Frank!
Welcome to Let's Be Frank, the weekly podcast that gives a quick take on U.S. stocks from the perspective of a value investor. I'm Brian Frank, a professional investor for over 20 years specializing in small and mid-cap value stocks. Every week, I'll cover what is working, what isn't working, and talk about the value we're finding on the hunting trail. Find out more at frankfunds.com. Now let's get to it. What's working? Good earnings on consumer staples. Portfolio holding JM Smucker, ticker SJM, rallied around 15% this week on improved earnings and profitability. Staples aren't nearly as exciting as space stocks, but consumer staples have a lot more fundamental backing. What I mean by that is a lot of the value in JM Smucker is here today. It already pays a 4% dividend, they're reducing debt on the balance sheet, and it trades about 20% below where it normally trades. Compare that to SpaceX, which trades at over 100 times sales, and all the value is in the far future. To me, I'd rather have that value today, and my experience shows that that's where the durable long-term returns come from. Next, let's move on to what's not working. For several years now, my clients and I have had positions in independent power producers like NRG Energy. The ticker symbol is NRG. Unfortunately for NRG, it made new 52-week lows this week. Analyst estimates for 2027 and 2028 have been consistently climbing, but this was a volatile week for AI and technology stocks, and I would consider my independent power producers to be AI adjacent because they're providing a lot of the electricity to those data centers. Sometimes those short-term factor trades, like moving all AI stocks together, will move your stock against good fundamentals. That was definitely the case for NRG this week. Next, let's turn to the hunting trail, where I'm always searching for value. On Frank Value Fund's most recent holdings disclosure, we had a new position in ticker symbol SAIC, or Science Applications International. This company is a defense contractor, providing technical and engineering support to the U.S. military. Defense contractors had a rough start to the year, with Elon Musk's DOGE initiative scaring investors into thinking government spending would be cut. After that, advancements in AI coding applications caused all software-related technology businesses to suffer. Making matters worse, SAIC had their own execution problems, with management going after business at any cost without regards to profitability. Now, there comes a point when a stock is going down so much that you're being compensated for all risks. My research showed that below $90 a share, investors were being compensated for pretty much most of the things that could go wrong with SAIC, because at that point, the whole market cap was under $5 billion, but long-term free cash flow production is expected to be above $500 million. If you take $500 million and divide it by the market cap, you get over a 10% yield. In my experience, if a company never grows again, 10% free cash flow yields limit the downside to break even. Value investors tilt expected values positive by focusing on the downside first, and that's definitely what we did with SAIC. Since then, SAIC has had several positive developments that point to future growth above expectations. A new CEO changed the strategy from win at any price to disciplined, margin-focused contracts. DOGE did not cut any material government spending, and more relevant to SAIC, the military budget could rise as much as $445 billion, or 44%, in fiscal 2027. These positive developments have de-risked the situation, and we went from keeping SAIC at an initial position size to a full position size. Furthermore, I'm on the hunt for more value in the defense contractor space because I think the market is slow to update on some of the real positive developments here. Wrapping up, defense is still cheap. We like consumer staples, I like defense contractors, and I'm definitely avoiding the space stocks. More to see next week. Thanks for listening.
Performance data quoted represents past performance and does not guarantee future results. The investment return and principal value of an investment will fluctuate so that an investor's shares, when redeemed, may be worth more or less than their original cost. Current performance may be lower or higher than the performance data quoted. You may obtain performance data current to the most recent month end by calling the Frank Value Fund at 1-888-217-5426 or visiting our website at frankfunds.com. Returns include reinvestment of any dividends and capital gain distributions. Non-FDIC insured, may lose value, no bank guarantee. The fund's investment objectives, risks, charges, and expenses must be considered carefully before investing. The prospectus contains this and other important information about the fund, and it may be obtained by calling 1-888-217-5426. 5426. Please read it carefully before you invest or send money. This publication does not constitute an offer or solicitation of any transaction in any securities. Any recommendation contained herein may not be suitable for all investors. Information contained in this publication has been obtained from sources we believe to be reliable, but cannot be guaranteed. The information in this publication represents the opinions of the individual portfolio manager and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Also, please note that any discussion of the fund's holdings, the fund's performance, and the portfolio manager's views are as of the recording date and are subject to change without notice.